Well, how's it going, friends and family? My name is Amos. I'm running on no sleep. That's a lie. I got like an hour and a half last night. I'm grumpy and I feel like a bag of ass. But I think it's the perfect time and a mindset like this type of thinking for me to assess the opportunity that's surrounding Kimberly-Clark and Kenvue. What I'm telling you is that by the end of the video, we will both understand whether it's a good or a bad idea. So if you're catching my drift, it's 2 nipples, 1 chest, 2 stocks, 1 video. That sounds good with you. Let's go ahead and get into it. So as you can see on your screen right now, Kimberly-Clark, ticker symbol KMB. It's a paper-based CPG company headquartered in Dallas, Texas, I do believe. Year to date, their performance is atrocious. They're just falling off a cliff. We're talking about negative 21.7%. If you zoom out 1 year, doesn't look any better. 5 years, it does not get better. If you zoom out, maximum timeline, then looks pretty good. But remember, past performance is not indicative of future gains. And if we pull up Kenvue, which was formerly a part of Johnson & Johnson, this is the company that's responsible for Band-Aids, Tylenol, baby powder, baby shampoo, all of those little various items you can get in the pharmacy aisle, even like multivitamins and whatnot. Year to date, pretty rough situation for them as well. Negative 24%. Past 1 year, negative 30%. So off the surface value, I can see why a lot of value investors are attracted to and are trying to do their due diligence about Kenvue and Kimberly-Clark. They seem to be 2 very popular blue chip household names that are on the sell-off. I completely understand where you guys are coming from. And just in case you're not too familiar with Kimberly-Clark, I interviewed with this company back during my MBA days, so I'm pretty familiar with them. But when you think about anything and everything related to paper-based products, including paper towels, toilet paper, diapers, tampons, yeah, that's Kimberly-Clark. Now, do you feel bullish about that future? For me personally, here's what I'm trying to say. When we think about all of the household essential CPG players, CPG is consumer packaged goods. Anything that you can buy online or on the grocery shelves or at Costco that you can bring home with you. And it's a pretty big category that includes like laundry detergent, shampoo, razors, even packaged foods, right? And multivitamins. When I think about that sector, Procter & Gamble, I like. When we think about Unilever, I like. Colgate-Palmolive, believe it or not, their ROIC, return on invested capital, I think it's best in class out of the entire group here. I like Colgate. Think about Church & Dwight, I like. When I think about Clorox, I like. When I think about Kimberly-Clark, who is number 4, out of the top 10, I would argue they're the worst one. Yes, I know that's a hot take. If we jump on over and take a look at their financials, I'm on the income statement, and we take a look at their top line, also referred to as their revenue. In 2015, they generated $18.5 billion. And what's really disappointing is, as we fast forward with Kimberly-Clark, you would think after 10 years, they should be at least generating, what, $21, $22, $23 billion? No, dude. Trailing 12 months, they posted $19.7 billion of revenue. Now, I will give them props where props is due, because that's up 11.6% year over year. But in the grand scheme of things, $18.5 billion to $19.7 billion in 10 years, that's just not good enough. But if we scroll down and take a look at their bottom line per share, is it a better situation? Not exactly. In 2016, it was $5.99 of profits per share. Bottom line per share. Earnings per share. They're all the exact same thing. Trailing 12 months, it's $5.91 of EPS. So, they're not necessarily increasing their profitability per share. It's pretty much flat. And if we jump on over to take a look at their balance sheet, $617 million of cash on hand. To that, take a look at their total debt situation. $7.3 billion of debt. Friends and family, that's a lot of debt in relation to the cash on the books. If we take a look at their cash flow statement, does it get better? $1.6 billion of free cash flow. I'm not going to lie to you, that's pretty good. But what's not good is negative 42% year over year. Guys, that's not good. And when we think about Kenvue, which is the company that Kimberly-Clark is paying $48 billion in order to buy out, is it going to be any better? Well, let's take a look at their income statement, their revenue. If you take a look at from 2019 to the trailing 12 months, it's going from $14.3 billion to $15 billion. I mean, it is growing, but not at a rate where you would be impressed to write a letter to your ex-wife and saying, hey, the CAGR for this company is 7, 8, 9% year over year. No, it's not. We're talking about sometimes it's up by 4%. Sometimes it's down, 2.9%. It really depends. This is a company that's up and down in generating gross sales. For me, that's a red flag. When you buy a business as a share owner, don't you want to know that your ROI, that this company is generating cash and is a company that is reliably growing in all of their metrics and fundamentals year over year? Well, with Kenvue, it's up and down, up and down. And to make matters worse, when we take a look at their profits per share, it's going from $1.21 back in 2022, fiscal year 22, to 75 cents in the trailing 12 months. So their margins being squeezed, the profitability being decreased. Are their books good? So they have $1 billion of cash on the books. Pretty good, not bad, especially in relation to their market capitalization. $30 billion, not too bad. And if we scroll down to take a look at their total debt, $8.7 billion of debt. So when you combine the two companies, that's a lot of total debt that's going to be on the books for Kimberly-Clark in the future. And also a lot of pending lawsuits that are going to be coming their way. Because with Kenvue, it is what it is, but most of their products, including the baby powder, the Tylenol, and some other various products, they're constantly facing litigation. And for a big corporation, that's normal to be facing lawsuits. But when we think about Kenvue, they lose these lawsuits because they're found liable of causing harm and damage and pain to the consumers. It's one of those things where you have to take into consideration where this company is also paying out millions, if not billions of dollars in losing lawsuits. When we take a look at their free cash flow, $1.3 billion for the past 12 months. In 2022, they generated only $39 million. So that is a pretty healthy rebound, and I'm assuming that's when they did a payout for one of their court cases where they lost. But what is not pretty is that it dropped, 50.7% year over year. So it seems like both of the companies, they're really losing the ground when it comes to their free cash flow. Not good. But as I just alluded to, I'm all over the place. I should have started out the video by mentioning that Kimberly-Clark, they're going to be spending, $48.7 billion in order to buy out Kenvue. I mean, is this going to be a good strategic plan? I think the reason why Kimberly-Clark is willing to overpay in order to buy out Kenvue, we'll be looking at the nuanced details of the transaction itself, but when you think about Kimberly-Clark's gross sales, what you want to see is organic growth through your own products, that the numbers are growing year over year, right? But in the case of Kimberly-Clark, I mean, what I am seeing, I don't understand how on an annualized level this is increased by 11.6%. Because in fiscal year 2023, we're talking about $20.4 billion. Fiscal year 2024, it's $20 billion, and now it's $19.7 billion. Mathematically, this should be in the red. It should be like a negative, like a 2, 3, 4%. 11.6%, it makes no sense. If we break it down on a quarterly basis, every 3 months, this is more reflective of what their true numbers are. When we think about their gross sales, it has been stagnant for the longest time and then only dropping since the end of 2023. So they're panicking and they're trying to find a way in order to increase their overall revenue. So when you buy out another company, then those numbers are going to be posted onto your financial statements in organic growth through that acquisition, through that buyout, and now your revenue is magically going to jump up. So I think Kimberly-Clark, they're panicking because as a traditional household CPG company, they're really suffering. They're not growing. As a matter of fact, they're only shrinking. And I'll give you a bonus, right? When we think about Siri, a company that Warren Buffett went balls deep into, I believe Berkshire Hathaway, they own about a third of all the shares outstanding. They're a majority share owner of this company. When we look at their revenue as well, it's the exact same situation as Kimberly-Clark. It was growing leading up to the pandemic. And ever since then, it's just been dropping since, Q2 of 2024, $2.1 billion, and it's slowly decreasing by 4% year over year. And now the bleeding has been stabilized and it dropped 0.5%. But the case still stands that the amount of revenue that SiriusXM is generating is about $2.1 billion quarter after quarter, nonstop. So by buying out Kenvue and paying a premium to do so, $4.1 billion in a fiscal quarter, and if we add on Kenvue's quarterly sales of $3.7 billion, now their revenue is going to jump up, right? It's going to be just shy of $8 billion. It's like, wow, their revenue grew by almost 100%, but if you read between the lines, it's because they overpaid for Kenvue, and that's why they're experiencing inorganic growth. And what I want to propose to you is think about this logically and strategically. This is going to be Business Class 101. Kenvue used to belong to Johnson & Johnson. Right? Johnson & Johnson used to have three arms of the business: pharmaceuticals, that's what they're famous for, medical devices, but also the essential CPGs, like what you see on your screen right now, Kenvue. You have Zyrtec, you have Aveeno, Listerine, you have Nicorette, Neutrogena, you have Band-Aid, Benadryl, and then where's the famous Tylenol? I can't believe it's not, right there, Tylenol. And here's the kicker. I may or may not have worked for the parent company of Kenvue when they used to be a part of the umbrella of the biggest pharmaceutical company in the world. So I do have line of sight of this business. So when we think about Johnson & Johnson, if a business segment in your operations is thriving and has a promising future, think about, don't take the emotions out of it, okay? Would you keep it or get rid of it? Think about it for a second. If there is a business segment in your operations that's crushing it and it's helping to pump your numbers and it's helping your margins, would you get rid of it or would you keep it? What I'm trying to say to you is that Kenvue is the fall guy. Kenvue and the CPG products that you see on your screen right now, they were holding back Johnson & Johnson from maneuvering in a more agile and nimble fashion, because the CPG products right here, razor thin margins, always and constantly facing lawsuits, and low growth, especially in comparison to the pharmaceutical arm of the business. The CPG arm, as we just learned, their numbers were growing at a rate of 1, 2, 3%, and sometimes going down 1, 2, 3%, inconsistent. And it also doesn't help that when you take a look at the grocery shelves or the pharmaceutical aisles, the generic or knockoff brands are absolutely crushing them. Why would you pay, $14 for a box of Tylenol when you can get the generic Costco, Walmart, or even Target brand for $4.99? And we could do the exact same thing with Zyrtec. Why would you pay $30 for 120 pills when you can get it from Costco or Sam's Club, 365 pills for $14, right? So when I think about Kenvue, dude, I am not bullish about their future. This is an entirely different ballgame when you compare it to Procter & Gamble. When we think about laundry detergent, when we think about dishwashing detergent, when we think about toothpaste and toothbrushes, Entirely different league than making medicinal CPG products that have a generic or knockoff brand, and they're losing market share, and it's a very competitive landscape. And so when we circle back to the question and thinking about it logically and strategically, why did Johnson & Johnson spin off Kenvue? It's because it was the disgusting tumor, the pimple, the ankle weight, the monitor that's strapped, attached to their left ankle, and it's weighing down the team, the fall guy. So by cutting them and getting rid of them, now Johnson & Johnson's numbers look a lot better, and it's a lot more profitable as an enterprise. By getting rid of Kenvue, they did see a small drop in their gross sales, but they bounced back, and it's just business as usual for Johnson & Johnson. They're thriving. But with Kenvue, their operations wouldn't be as optimized. So in my opinion, Kenvue as a business, not attractive. And the fact that Kimberly-Clark is so desperate because their numbers are so stagnant and flat and are declining, as a matter of fact, for them to be buying them out in order to re-energize the company, for me, I just smell desperation. I just feel like both ends of the party, it's like, ooh, you know what I'm saying? Because think about it like this. If Kenvue was truly attractive, undervalued, and had a portfolio that had a promising future, why the heck did Church & Dwight not try to buy them out? Why did Colgate-Palmolive not try to buy them out? Why did Procter & Gamble not try to buy them out? My baby's crying, I'm sorry. It's because at the end of the day, Kenvue just has way too much litigation, regulatory probing, and the current administration, dude, they went on record by making claims that Kenvue's products cause certain diseases, illnesses, or whatnot. There's a lot of bad PR. There's literally people that will believe everything that the current administration says, and they're going to boycott their products. That's going to hurt the bottom line for Kenvue. Now, granted, Tylenol probably only makes up, 4, 6, or maybe 7% of the sales for Kenvue, but that's still going to be a dramatic drop of 4, 5, 6, 7%. So transitioning on over to my game plan, what are my takeaways? Now, mind you, I'm sleep deprived, okay? Now, I'm a dividend growth investor. So for me and my objective, when I take a look at Kimberly-Clark's dividend profile, it's pretty juicy, right? A 4% dividend yield, dividend growth rate of 3%, 53 years of growing their dividend. The payout ratio is pretty high. For a CPG, for their payout ratio to be around 85%, I know they're very mature, but it should be around 70, 75. That's a yellow flag. So for me, Kimberly-Clark, it really doesn't make sense because I do not see them being a compounder going forward. Yes, leading up to like 2022, they were a compounder, right? If we look at their max timeline history right here, up until like this point, I guess 2020, I would argue very attractive, very good. But since then, it's just been falling off the cliff. And I don't know. Some people might see this as an opportunity, but I don't think they're going to compound. I think Kimberly-Clark is just going to be one of those companies that gets a modest gain, I guess, after this recovery of like 5 or 6% year over year, but it's definitely going to underperform the S&P 500. That's not financial advice. That's not me saying that's the fundamental truth. That's just me guessing, right? And because their dividend growth rate is not juicy, 3%, I feel like that's just keeping in line with the rate of inflation. If this was more of like 5, 6, or even 10%, I would change my opinion. I'd be like, well, with a 4.2% yield on cost and the dividend growth rate being really, really juicy. But the fact of the matter is, I don't think they can grow their dividend more than 3%, because when you take a look at their earnings per share, because the dividend payout ratio is predicated upon the percentage of their EPS that's utilized for the dividends per share. And if I go back and show you their dividend screen, $5.04 is the annual dividend payment. And we take a look at their earnings per share, it's $5.91. So of that $5.91, $5 and like 2 or 3 cents will be used for the dividends, which means there's not much left over in order to reinvest back into the company or in order to expand the operations. And to make matters worse, their earnings per share is really inconsistent, right? Sometimes it goes up. I feel like it was a really good trend from 2018 to 2020, $6.87, and then it drops off, and then it goes up, and then it drops off. That's not what you want to see. Friends and family, I'll show you a much better alternative in terms of the earnings per share, what a mature and an established EPS should be looking like for a CPG player. Consistently up and to the right when we think about Procter & Gamble. 2019 was a fluke year. When we look at 2016, $3.69 to trailing 12 months, $6.85, increasing year over year, that's what we want to see. With Kimberly-Clark, that is just not the case, right? And so I don't think they have the confidence in order to increase their dividend by more than 3% year over year. But having said that, I mean, if you're looking for a steady dividend payout that is qualified because you're retired, then I guess one could say that Kimberly-Clark's not the worst idea in the world, but I feel like there's far better choices out here. But it makes sense. A qualified dividend payout that's going to be taxed at 0 or 15 or 20% for us Americans. Dude, if you're from like South Africa or Romania, I don't know what the tax rates for your dividends are. But for Americans, qualified dividend payout is really good. I'll say it again. I feel like there's better opportunities out here. Like Procter & Gamble's dividend profile looks much better to me. PepsiCo's 4%, dividend growth rate 6%. Much better options. But having said all of that, here's why I'm not completely dismissing Kenvue and Kimberly-Clark. And here's why I'm eyeballing potentially jumping in for a short-term play. Because they're expecting that deal to close at the second half of 2026. When they say second half, usually August, September. About a year from now, this transaction would close. And so if and when this deal gets approved or closes, Kenvue shareholders are going to receive $3.50 in cash per share of Kenvue that you own and about 0.15 shares of Kimberly-Clark. Now, they're currently trading for about what, $102, right? So you have to think about it. A year from now, will Kimberly-Clark still be 102 or will they be 80 or will they be 120? It really depends because the 0.15 shares of Kimberly-Clark that you get, that cash value could go up or down depending on their stock price. So if we just do some quick math and I show you $102 a share right now, Kimberly-Clark, okay? And if we times that by 0.15, this is the cash value that you would get per share of Kenvue that you own, $15.30. Now, if we add on that cash value of $3.50, then you're expecting to get $18.80 for every share of Kenvue. Now, mind you, Kenvue, they're currently $16.14 a share. So if this buyout gets approved, which I don't really see why there would be any pushback, considering a paper-based company buying a medicinal CPG company, I don't think that would create any problems. Because the lines of business are so different and drastic from one another, I don't really see this getting rejected. So having said that, if I buy into Kenvue for $16.14 a share right now, then a year from now, I could potentially get $18.80. Some people might argue that's a very easy 16% gain for holding on to a stock 365 days. Now, worst case scenario, if it gets approved in December of 2026, then it would take about 13 months for me to get that 16%. But some factors to also keep in mind. Right now, Kimberly-Clark, $102, but they're falling off a cliff. And to be honest with you, looking at their technical analysis indicators, I don't see any line of support. They're crashing pretty hard. Now, usually when this kind of sell-off happens in one fiscal trading day, negative 14.5%, one could argue that's oversold. Like that's an emotional overreaction. And to verify that, if we take a look at their RSI, the relative strength index basically tells us whether or not a company is oversold. If it's less than 30, it's oversold. You want to see an RSI for a company that's trading on the stock market to be around like a 40 to about a 60. That's a healthy zone. If it's above 70, like an 80 or a 90, then you know that stock is overbought and a correction might be coming soon. Too many people piled their money in. That means there's going to be people that are going to be selling in order to capitalize on the gains, because when there's a lot of people buying in and less people selling, that stock price is going to get artificially pumped. Some people say it's a squeeze. And for day traders, that's the perfect opportunity to jump ship with your profits. When we think about Kimberly-Clark, their RSI is a 21. dude, that's really freaking low. Like that's the pandemic type of numbers that you see in 2020 or in 2008, 2009 when companies were being sold off. Their RSIs were also around a 21. So I'm going to go on record by saying I can't tell the future. For all we know tomorrow, Kimberly-Clark could rebound back up to 105, 110 a share, or even in a very delusional world, jump back up to like, $150 a share like they were back in March. Do I see that happening? Not really. I'm not trying to be a bear, but I don't see that happening in a statistical probability calculation. I don't see it happening. But could they bounce back to 105, 110 a share? Absolutely. But this whole idea of getting a 16% gain in about 10 to 13 months of holding on to Kenvue, again, is predicated upon Kimberly-Clark being $102 next year. What happens if the share price goes lower and lower? For instance, let's go ahead and assume that Kimberly-Clark sells off, and by the time this transaction, this buyout closes, Kimberly-Clark is $80 a share. If we take 15% from that, you get $12 per share of Kenvue that you own, plus the $3.50. I would get $15.50, so I would lose money by buying into Kenvue at $16.14 a share. Does that make sense? However, if we think about it in a very optimistic lens, and I don't know, Kimberly-Clark goes back up to like 125, we take 15% from that, $18.75, and we add on the $3.50, and now we get $22.25 for my $16 Kenvue shares, if I were to buy Kenvue today. So my train of thought is this. I'm not saying that I'm going to do it, but this is what I'm flirting with. I go ahead and buy into Kenvue at $16.14 a share. I mean, in the past 72 hours, they're up 18%. Because this news broke out, right? So buy into Kenvue, $16. I pocket the dividends as I wait for the buyout and the transaction to close and pass through all the regulatory seal of approval. You know, they say that's easy money. But that also begs the question, do I want shares of Kimberly-Clark? Because at the end of the day, by doing this play, by buying into Kenvue, that's going to be converted into Kimberly-Clark. Do I like Kimberly-Clark, the company? I mean, I like their products, but do I like them as an investment? Because fundamentally, when you buy into a stock, you become a business owner of that enterprise, of that operation. Do I get a fuzzy feeling in my stomach? No, I do not feel excited about Kenvue or Kimberly-Clark. Having said that, I would rather double down and buy more shares of Procter & Gamble than buy into Kenvue, than buying into Kimberly-Clark. I would rather buy Colgate-Palmolive than buy into Kimberly-Clark. I would rather buy Clorox than Kimberly-Clark. Now, I don't know what I'm going to do. I'm going to be honest with you. I don't know what I'm going to do. So let me know your thoughts. My ability to think critically right now is way off. So I would love to hear your input. What am I missing? Tell me, put me on. I'm a guy that's always willing to change his opinion if I know that I am wrong. If I am objectively wrong, I am always willing to alter my way of thinking, because I think the worst thing to do in this world is to feel like, to have that attitude and ego that's so big, it's like, I can never be wrong. I'm always right. That's the worst type of people. Actually, there's a lot of bad types of people, but that's one of the category of the worst types of people to be around, especially if your supervisor or manager is that type of person. Super bad. Possessing a humble mindset and a learner's perspective of that everyone and anyone that I meet can teach me something, I feel like that's probably the path to a more fulfilling life. If you can't be coached, if you can't be corrected, if you can't be told that you're wrong, and you always get defensive, argumentative, and angry, there's something wrong with you. Anyways, I'm not trying to preach. So what am I missing? Kimberly-Clark, Kenvue, if you're buying into it, if you are a share owner, let me know, because I am always willing to change my mind. Having said that, I love you guys. Stay safe. Good luck in the stock market. And I will talk to you next time. Peace.